Everyone's chasing gold, but is this the right time to follow the crowd? This is Inside ETFs, and we're talking about gold. The precious metal is glimmering again, and investors can't get enough. For centuries, it's been the ultimate safe haven, and in 2025, that narrative is only gaining steam. Gold ETFs are seeing a flood of inflows, with prices hitting multi-year highs. After doubling in value in just a few years, some see strength, but others see signs of a stretch rally. So is gold still a smart hedge or just a shiny distraction? Let's ask Cinthia Murphy, investment strategist at TMX VettaFi. So Cinthia, everyone seems to be hitting record highs lately, but gold's rally really stands out in scale. What's really driving this outsized move?
It's been really, I think, a confluence of factors. So you have on one side this insatiable appetite for diversification. We've talked so much about concentration risk, especially among large cap stocks today. And so this push to diversify portfolios have benefited everything from gold to alternatives to Bitcoin, commodities in general, all of these types of assets. So gold has really benefited from that. A lot of money has gone into gold, to your point, almost $30 billion in physical gold ETFs alone this year. There's also, I think, gold is benefiting from this kind of like structural strength and improving opportunity cost as we enter a new rate cutting cycle. Gold is a non-yielding asset, so it struggles to compete when rates are high. But when rates are coming down, it makes gold more compelling relative to yielding assets. So that has also benefited gold.
So do you think this rally can keep going, or are we close to the top?
I think we probably will see profit taking at these high levels, especially as we approach the end of the year. You get some kind of portfolio rebalancing. But at the same time, on the flip side of that, you have big firms like JP Morgan, Goldman Sachs. They're all coming out with really lofty gold projections for next year. $4,000 an ounce gold. Goldman Sachs said even $5,000 an ounce a gold is possible if the stars align just right, if the economy remains a concern, GDP growth, inflation. So it could be that we see some profit taking some pressure here, but theoretically, if you look at these projections, there's at least another 7-10% upside potential just to meet these targets. So, it could continue for a while.
So Warren Buffett famously called gold a sterile asset, no income and no yields. Beyond physical gold, are there smarter ways to play the space?
Today in ETF space, you have a lot of unique takes. For example, to your point, non-yielding assets, today you can actually generate income in a gold position with the use of options. So there's ETFs like Simplify, YGLD, or NEOS, IAUI, I believe is the ticker. These are ETFs that are giving you exposure to gold, plus generating like double-digit distribution rates, lots of income on that position. So those kinds of unique takes if you want to get gold plus something. There's also the miners, which we're going to talk about in a minute, which is an equity play on the gold space. And then you have even ETFs that, combine gold with other assets, so multi-asset type of portfolios as well.
So let's talk about those gold miners that you mentioned. They've quietly outperformed this year, yet miner ETFs are still lagging. What's causing the disconnect?
So really strong year. I think a lot of it has come from strong balance sheets. The earnings season really showed that these companies today are doing much better than they were in the past. They've really cleaned up a lot of their balance sheets. They're operationally efficient, all of the good stuff. However, if you think about one of the big drivers for gold demand has been appetite for diversification, protection for any turn, safe haven type of play. Miners are equities, and they're risky equities. They're perceived as volatile. They tend to go up and down dramatically. So we haven't seen the appetite for gold really trickle into the miner space. And I think it's because it's a risk asset. It's an equity play. But the performance has been phenomenal.
So overall, for gold markets, investors watching on the sidelines, is it too late to join the rally, or is this still a smart entry point?
If all things remain in place and there's no suggestion that things are going to change, the rates are coming down because, jobs are faltering. They're still concerned about inflation. The economy is still at risk. GDP growth has moderated. All of these factors, these macro drivers are still in place. So it looks like gold has an upside to run still. Does he have another 40% leg up? Current projections don't suggest that, but there's still upside room. So I don't think it's too late.
So finally, Cynthia, gold and Bitcoin are often called digital versus physical havens, but are they still competing, and what's the better option in your opinion?
Half of us believe Bitcoin is, the other half disagree. So there's a lot of debate there. I think Bitcoin is still seen a lot as more of a risk asset than a safe haven. Both are equally powerful when it comes to this diversification push as alternative assets. I would say today in ETFs, why not own both? You can have both, or you can have even a fund like BTGD, which for every dollar you get $2 of exposure, one in Bitcoin and one in gold. So there's clever ways to have it all.
That was Cinthia Murphy from TMX VettaFi. Don't forget, you can watch more videos on Reuters.com.